Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. As usual, I'll be discussing key earnings and economic data for the coming week. Starting with corporate results, it's another busy week as earnings season continues in the US. On Monday, we have UBS Group and Netflix. On Tuesday, earnings from TUI, State Street, Johnson & Johnson, Procter & Gamble and Verizon. Wednesday sees earnings from General Electric and Ford. On Thursday, we have Cas Minerals, Diageo and Sky from the UK, and American Airlines, PayPal, Caterpillar, Intel and Starbucks, all from the US. And it's a big one for the FTSE on Friday with HSBC reporting. Moving on to the economic calendar, rate decisions from the Bank of Japan and the European Central Bank, as well as UK and US GDP, will be the major events to watch. On Tuesday, in addition to the rate decision in Japan, we have Eurozone ZEW sentiment and consumer confidence. Wednesday sees manufacturing PMI from Japan, US home sales, oil inventories, manufacturing and PMI numbers from the Eurozone and the US, and employment data in the UK. On Thursday, we'll get interest rate decision from the ECB, as well as jobless claims and new home sales in the US, and Japan's CPI and policy meeting minutes. And alas, we finish a busy week in the economic calendar with US and UK GDP and US durables goods. So let's take a quick look at some key events this week. So it's been an intense build-up to the European Central Bank monetary policy meeting on Thursday. Earlier in the month, the minutes from the last ECB meeting suggested that the ECB could update its forward guidance at the beginning of 2018. The market interpreted this as the ECB looking to drop its pledge to keep buying bonds when it gives its forward guidance in the next meeting. As a result, investors brought forward their expectations for the first rate hike since 2011, causing the euro to rally to a 3.5-year high. However, the ECB has since backtracked on these comments, saying that they need more time to assess the outlook for the economy and the euro. This means March is looking more probable for changes to the forward guidance. Investors will be looking for more clarity on the direction of ECB policy. Speakers over the past week have given mixed views. ECB official Jens Weidmann seemed to rule out an interest rate rise this year, saying that expectations for a mid-2019 rise were in line with ECB's guidance. On the other hand, ECB hawk Ardo Hansen said that the ECB bond buying programme could end in one go in September, without any further tapering. The ECB have stated that the bond buying programme must conclude before interest rates start to rise. The euro continues to trade at 3-year highs moving into the meeting, and with the ECB not in favour of a strong euro as it hinders prospects of inflation rising, we're unlikely to hear any euro boosting comments from the meeting. And should ECB President Draghi disappoint the market, the euro could continue to fall away. So while the third quarter saw the UK economy grow by 0.4%, doubts are starting to stack up as to whether it has performed strongly in the final quarter. The National Institute of Economic and Social Research have predicted a fourth quarter UK GDP growth of 0.6%. However, other forecasts point lower. While still ahead of the 1.2% annual growth predicted at the start of 2017, this would be down from 2016's 1.9% growth and would be the weakest level of growth for the UK since 2012, at the height of the Eurozone crisis, when the economy grew by just 1.5%. One of the main reasons that the UK economy has slowed down over the past 12 months is due to the increase in inflation stemming from the post-Brexit devaluation of the pound. Rising prices and falling wages in real terms have tightened consumer spending, having a noticeable impact on the economy. Business investment is also lower, weighing on the growth, but in support of economic growth, manufacturing activity is at its highest in a decade. So should there be any surprise uptick in UK economic growth, it is most likely to stem from this. A better than expected reading from UK GDP could boost the pound. which is currently trading close to post-Brexit highs versus the dollar. On the other hand, signs of further weakness in the economy could pull sterling lower. In the US, growth is picking up strongly, which is likely to be highlighted in the release of the US GDP also on Friday. The Reuters poll is pointing to economic growth of 3% in the fourth quarter, but could still be adjusted higher. Economic data has been generally strong with a string of record highs in the US stock markets, another encouraging sign. Earlier in the month, Federal Reserve official William Dudley said he expected the US economy to continue growing at an above-trend pace. Forecasts are suggesting that growth could come in stronger than 3%, especially given the strong retail sales and CPI data. Over 2/3 of US economic growth is derived from consumer spending, so retail sales data and CPI should give some interesting indications. The dollar has had a difficult start to the year, dropping around 3% in the past 30 days alone. But the end of the week last week saw the dollar ease back from the recent three-year lows, so a reversal could be on the cards. A strong GDP reading on Friday could be sufficient to halve the decline in the dollar. That's all for this week. Our senior market analyst Jasper Lawler will be back alongside me next week. Until then, you can get more videos as they're released by following us on social media. Thanks for watching and the best of luck trading.